There's almost like this false diversification throughout the broader traditional finance where you have bonds, stocks, these different allocations, and they think they're diversified, but they all have the same risk, which is they depend on the credibility of the issuer of the currency. And so when you buy stocks, you're betting on future cash flows, you have a claim on that. That's denominated in fiat. When you have bonds, your principal's in fiat and the fixed coupons are in fiat. If you're holding cash or cash-like equivalents, that's directly eroded away the purchasing power due to the monetary policy and fiscal policies. And so when you own Bitcoin, you protect yourself against a risk that all these other asset classes don't protect you against.
Hey everybody, Tyler Rowe here with BitcoinTreasuries.net. My guest today is Sam Callahan. He's Director of Bitcoin Strategy and Research at Oranje BTC, the largest Bitcoin treasury company in Latin America. Before that, he was lead analyst at Swan and an advisor to Bitcoin miner Mara. Sam, good to have you.
Thanks for having me on, Tyler.
Yeah, really excited. So let's dig in. I walked into the studio today, I looked at the block clock, price is way down, sentiment on X is in the toilet, treasury stocks are down, STRC is having trouble holding par, in the near term. Where's your head at on, I guess, macro Bitcoin right now? Does the drawdown change anything for you, or do you just have nerves of steel at this point?
I mean, I'm pretty numb to Bitcoin's volatility. I see it as a gift. For anybody who has long-term conviction in Bitcoin as an asset, they should be really loving this price action to take advantage of it. And that's really how I see it. I've been through worse drawdowns before when the market infrastructure was more immature, Bitcoin's adoption was less substantial. And so looking at it today, down over 50% from its all-time high, it's pretty par for the course. So I really am unfazed by it. This is when those with conviction stay strong and take advantage of it, and those that didn't get washed out. They give up, they move on to other things that are shinier because maybe they didn't understand what they owned and why they owned it. And they move on because they were in it for short-term fiat gains when I'm in it for very different reasons, for building a future, more sound monetary system, as well as driving Bitcoin adoption because I think it's a technology that makes the world a better place. So we're in it for very different reasons.
I'm surprised. Like you said, I think a lot of the institutional money over the past couple of years that's come in has made the likelihood of some dampened volatility, especially the downside, just more plausible, because of the sheer market size. But to see Bitcoin at basically a 1.25 trillion dollar market cap, I mean, go back a year in time last summer, I didn't think we'd test these lows. Can we go much lower from here, Sam, given the structural changes Bitcoin has seen with, like I said, more institutional adoption. You've got ETFs, you've got Bitcoin treasury companies, you've got Sailor buying, with a persistent bid on Bitcoin, bringing billions of dollars, transmuting capital from traditional capital markets into Bitcoin. This has got to be close to a bottom, right?
No, I think Bitcoin could go lower from here. Absolutely. I think for it to go lower than here, we would need kind of a broader macro shock stock market correction where correlations go to one. I actually just wrote a piece about this. Bitcoin's correlation with equities have been rising over the past 5 years. And I think that's a function of it winning because of the institutional adoption of all the products that you talked about. Improved regulatory barriers have dropped. It has allowed institutions to get allocated to this space. But when that happens, you have really a shift in the investor base, and institutions kind of trade differently than individuals. They put on rebalancing strategies, hedging strategies. They look at Bitcoin relative to all the different assets in a diversified portfolio. And so as Bitcoin's likely the trading behavior of Bitcoin is going to be different than it's in early years when it was a very isolated niche market driven by individuals who were just interested in the technology, Bitcoin's infrastructure. There was not a lot of overlap with traditional finance, but now it's a very different ball game. And so when you have these shocks, and correlations go to 1, Bitcoin gets sold off first. It can trade like equities or risk on because it is very liquid, 24/7 asset. The only thing you could sell over a weekend. But it doesn't change Bitcoin's fundamentals of why it belongs in a portfolio. You know, one of the things that I talk about a lot is there's almost like this false diversification throughout the broader traditional finance where you have bonds, stocks, these different allocations, and they think they're diversified, but they all have the same risk, which is they depend on the credibility of the issuer of the currency. And so when you buy stocks, you're betting on future cash flows. You have a claim on that. That's denominated in fiat. When you have bonds, your principal's in fiat and the fixed coupons are in fiat. If you're holding cash or cash-like equivalents, that's directly, eroded away the purchasing power due to the monetary policy and fiscal policies. And so when you own Bitcoin, you protect yourself against a risk that all these other asset classes don't protect you against, right? And that's you look out at the macro environment today with these highly indebted governments and the increased risk of them turning to currency debasement or financial repression, capital controls. Those are the risks that Bitcoin really protect against and why it belongs in a portfolio. So even though like its correlations will fluctuate, the fundamentals of Bitcoin are designed to remain unchanged. And so, Bitcoin today, I think people still view it as a risk on asset broadly, but as the macro environment deteriorates and some of these risks become more prevalent in investors' minds, I think they're going to begin to view why Bitcoin's special. But we're in this transition period today. And so, I expect if we do see a stock market shock or anything like that, then Bitcoin could trade lower than it is today. Now, is it my base case? No, I think these are really attractive levels. And, that's why at Orange BTC, we're buying at these levels. We're really excited to take advantage of this price action because we are long term thinkers. We're building for the long term. So we're taking advantage of this. We just made a debt deal. We're using the proceeds to buy Bitcoin at these levels, and we're super excited about it.
I want to talk about something that comes up in almost every conversation I have with Treasury executives. They get the Bitcoin thesis, they see the macro case, but then they walk into a board meeting, and the first question is who's holding it? Are they regulated? Are they insured? Can we audit this? That's where BitGo comes in. BitGo is an OCC regulated national trust bank. That means they operate under the same federal oversight as the institutions your board already trusts. Your assets are held in segregated trust accounts, never commingled. They're secured in 100% cold storage with multi-signature architecture. If you're building a case for Bitcoin on your balance sheet, BitGo is the custody partner that turns a board conversation from why into when. Visit bitgo.com/Bitcoin-treasury to connect with their team.
It's the best kept secret known by every true Bitcoin OG. CoinKite has been building the gold standard in private key security for years, and they just raised the bar again. The Cold Card Q is an absolute powerhouse for serious Bitcoin treasuries. We're talking a full QWERTY keyboard, air gap protections, and it's built for maximum security. The brand new Cold Card MK5, it has a massive Gorilla Glass screen and new NFC functionality for an even more seamless experience. So if your business is large or small, there's a cold card for you. Head to store.coinkite.com and use the code 6BT at checkout for 6% off. Stop cutting corners on your Bitcoin treasury. You wished for it. Bitcoin is finally on sale. And if you're sitting on BTC and want liquidity without dumping your stack, Arch Lending can make it easy. You can get USD or USDC in minutes, and your collateral stays in qualified custody. They never rehypothecate your assets. As your assets move up and down in value, you can scale your credit line instantly or pull the collateral back when the market runs. If you need help, you get real humans 24/7, not bots. This is Arch Lending. Simple tiers, public pricing. You can check them out at archlending.com.
Yeah, can you dig a little bit more into that deal that you guys completed recently? It's denominated, if I have that right, in the local currency, right? In the Brazilian
Yeah, the
currency.
interest is denominated in BRL. Yeah, so it's kind of a first of its kind transaction in the local market with Itaú Asset Management. So Itaú, for everyone who doesn't know, that's the largest financial institution in that country by far. It's kind of like the JP Morgan of Latin America. And so to bring them into the fold and do a first of its kind, Bitcoin transaction, we think that's a pretty big deal. It's the first Bitcoin-backed loan that, with the proceeds primarily used to acquire more Bitcoin. And so this is more of a traditional debt instrument, but it's a long maturity, 5-year maturity with zero cash burden. So all the interest is paid at that 5 year. It's a bullet with really flexible prepayment options. And so we look at the price action today, and we had very low leverage ratio entering into this correction. And you want to actually increase your leverage at these times in the cycle when Bitcoin's corrected 50%. We look at Bitcoin's historical performance, and yes, past performance does not guarantee future, but, we look at the adoption trends and we look at its rolling 5-year uh, CAGRs historically, and basically our all-in costs with our FX hedging on top is around, 10 to 11% or so to speak. And so if Bitcoin outperforms that a year over the next 5 years, that's going to be accretive from a Bitcoin per share basis for our shareholders. And we would make that bet, especially coming off a 50% correction. Bitcoin's CAGRs are usually even higher. So, our leverage ratio is sitting at like around 13% right now. Um, and we think it's like a very, very good deal with a partner that we're bringing into the fold, long duration debt, intelligent leverage. It's not the digital credit preferred, but it is smart leverage. It's leverage that only a public company with a large balance sheet with very little debt could get those types of terms. And that's the point of having a public vehicle that's focused on Bitcoin accumulation. And so
Right.
we're
Yeah.
excited about it. We're going to be buying at these levels, and we've been buying pretty much every week the last couple of weeks. We'll continue to do that in the future. Um, and we're just increasing Bitcoin per share for our shareholders.
That's really cool. Yeah, I think every Bitcoiner watching loves your side of that. Loves your side of that transaction, and their mouth is watering. Being able to see what public companies can do in these types of environments. As you think about allocating capital, I think so many Bitcoin treasuries have different strategies and ways they're able to raise money in capital markets and then deploy that into Bitcoin. How do you manage? Like there's memes out there of like Michael Saylor just smash buys whenever he can acquire capital. How do you guys manage your treasury and your Bitcoin accumulation? Do you take sort of a DCA strategy? Are there times when you're like, when price is down here, like, do you keep some dry powder around to really buy at attractive levels, Sam?
Yeah, I mean, it's kind of look, we've done a lot of research about like lump sum buying versus DCAing. And for us, it's kind of like we do take into account the macro picture a little bit. And, we've been investing in Bitcoin, working in Bitcoin for a long time. Right now we see a lot of uncertainty, and like so, we could have smash bought earlier, but we decided to kind of DCA a little bit in. That turned out to be the right strategy. This correction's been helpful for us. But when we see kind of really sharp corrections like this where sentiment's very low, we might buy some more. This isn't our first rodeo. That's the time when you want to really smash buy is when sentiment's in the gutter, buy when there's blood in the streets, all those typical tropes. And so we have a treasury committee where it's like four of us. We have a head trader who's excellent at what he does. He's been sitting on a trading desk for 20 plus years. So we use derivative strategies sometimes to purchase the Bitcoin. We purchase spots sometimes. It's all just to optimize for our execution and our entry prices. So I think we've actually executed really well if you look at our trading history of when our purchase prices are. And I think that'll continue into the future because of the personnel we have on team. So it's kind of like there's an analytical side to it for sure. There's also just understanding cycles and market sentiment. It's not, and then we have just different derivative strategies. As like we do call straddles versus selling puts, but it's not necessarily to like collect a premium necessarily. It's really to lower our cost basis and acquire Bitcoin in an intelligent way when the market conditions make sense to do strategies like that. So, um, hopefully that answers your question.
Yeah, yeah, it really does. And it's been interesting to see some of these treasury companies separate. I think it's very clear there is there are some differences, in the management teams from Bitcoin Treasury company to Bitcoin Treasury company. We've seen capitulation on some companies. Galaxy's come out with a report that says, there's going to be more Treasury companies that they think could be forced to sell. And what is it about your team that's made you guys so resilient and insulated from poor sentiment, maybe in Bitcoin's price, poor sentiment in the Treasury space generally? How have you been able to withstand the bear market, Sam?
If I had to put it shortly, I mean, we think about risk all the time. So it's really risk management, respecting Bitcoin's trading behavior and its volatility. That should be what you're optimizing for all the time, is just like managing risk, never being a forced seller, respecting that Bitcoin can drop another 20% from here. It's not out of the question. And structuring your capital structure to be resilient, to withstand that, so you're never a forced seller. So like, I have to give it to our founders who were raising capital. This was over about a year ago. They were given the opportunities to take on a lot more capital, but it was debt. It had kind of restricted covenants attached to it, and they said no. Not all capital. You shouldn't just always say yes when somebody's trying to give you money. You got to read the fine print, and they kind of felt that it was a little bit of a speculative fervor at the time. They wanted a low leverage ratio, and so we're kind of benefiting for wise decisions we made a year ago. Because, anybody who levered up at the top, they're in a little bit more of a challenging situation than somebody who's taking on leverage now, like I said. So it's just being like prudent, with and having discipline with the treasury operations and the capital raising activity, and then respecting Bitcoin. I think that's the key things.
I'm curious your take on you mentioned positioning your company to prevent forced selling, and that's I think certainly step one for any Bitcoin treasury that expects to survive long term and perform generate returns amplified against Bitcoin. What do you make of Michael Saylor's, I guess, optional selling? His positioning where he came out recently and said strategy is willing to sell Bitcoin. They sold a couple shekels. They sold 32 Bitcoin, which is nothing, compared to the balance sheet that Sailor's got 850,000 Bitcoin like that. I, 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 I had the same reaction you had right now. I just laughed when I heard that. I was like, what does that even mean? 32 Bitcoin. But what did you make of that, Sam? Was that something Sailor needed to do you think, to make a signal to the market? Certainly, I understand the aspect of maybe selling some high cost basis coins and then rebuying for tax purposes, maybe. But what's your take on the whole situation there?
Well, I really, I support it fully. It's something that I actually was talking about beforehand. Whenever I talk to any doubters around stretch and some of these perpetual preferred instruments, they're always like, how is he going to fund the dividend? How are they going to fund the dividend? Like, what happens when they lose access to their capital markets? How are they going to do it? And then I would say, well, they can sell the Bitcoin, and their brains would kind of break. And I was like, this is a highly liquid asset sitting on their balance sheet. And as an operating company, they have complete flexibility with how they use that asset, to to increase shareholder value, to increase Bitcoin per share. And so they are showing the market that, yes, this is a liquid asset, and this was like the S&P and the rating agency said, they basically marked it as a zero because, they said they were reluctant to sell it and yada, yada, yada. But obviously it shouldn't be marked at zero. It's worth tens and tens of billions of dollars. And so I think it's all about optionality. um, there's a difference between selling because you're in a moment of stress or you've lost conviction, you're capitulating, versus selling for strategic reasons. And the important part is that if they feel like selling some Bitcoin to retire debt or fund the dividends or buy back their stock because it's trading at a steep discount, if it increases Bitcoin per share or puts them in a better position and makes their capital structure more durable so that they can increase their Bitcoin accumulation into the future, they're thinking in decades here, not quarters. And so if they feel like selling some Bitcoin can achieve some of these objectives, then that's their decision because they think it's the most valuable move. It's all about being net accumulators. I think it's absolutely hysterical that a company who bought over 100,000 Bitcoin over the last year sells 32 or even sells 1,000, whatever it is. As long as it's net positive buyers, then what are we even talking about? I really think that. Even so, I talked about our debt deal. It's different than a preferred because we do have a maturity. It's due in 5 years. We bet that the Bitcoin that we buy with the proceeds of that loan will outperform our interests and it will be accretive. And we don't know what's going to happen over the next 5 years. We have MNAV expansion. We can issue equity. We could issue a different product, raise capital, pay down the debt over time. But we can't really model that out. And so we have to model out, okay, well, we'll have the Bitcoin that we use and we'll need to sell some of the Bitcoin to pay back the loan. But the bet is that it's going to outperform and we're going to left with net more Bitcoin than we did before we did the transaction. So it's accretive for our shareholders. But
Right.
there is a chance we'll have to sell some Bitcoin to pay back the loan. Does that mean that we're like bearish on Bitcoin, selling Bitcoin? No, it's actually we walked away with more Bitcoin than we did before. I mean, it's just like if somebody took out a personal loan of $10,000 to buy Bitcoin because they bet that it's going up, and then 3 years later they have to pay it back, but Bitcoin flew up to $1 million. They're not going to regret, selling a little bit of that Bitcoin to pay back, the $10,000 loan. It's like I don't know. I don't even know why we have to explain this. It's really silly.
Could you explain that to CoffeeZilla?
Yeah,
It's
I don't
like
really understand. It's all about optionality. So
yeah,
they have different levers they can pull, and the more that they have to increase Bitcoin per share, the better. And Bitcoin's just one of those tools. Now their goal is to acquire as much Bitcoin in an accretive way for their shareholders. And so a lot of this was about proving to the rating agencies, hey, this is a liquid asset. We can use this in different ways. Retiring the debt with some of their cash position was strategic. That was part of the rating agencies. They wanted to see some of that converts come down. They've spoken about how they want to retire that debt to improve the credit worthiness of the preferreds. And so they're always kind of thinking about like the credit risk, the equity risk. How do you optimize for the two? And so we think very similarly at Orange BTC. We've used proceeds to buy back our shares when they're trading at a discount because it's when you just do the math, it increases Bitcoin per share more. And that's really what we're laser focused on is increasing Bitcoin per share. So we said this in the disclosures, but we'll be using some of the proceeds to both acquire some of our shares at a discount, as well as acquire Bitcoin. And both will just help increase Bitcoin per share. So optionality is key. Math, it's really about following the math.
yeah. How optimistic are you that credit rating agencies can wrap their mind around this? It sounds like I think these things get a little overdetermined, and the market swings one too far each way. Saying the credit rating agencies guys are idiots. There's complete information asymmetry, but I think there, like you alluded to, there's got to be some back and forth there between rating agencies and Michael Saylor. Do credit rating agencies really matter that much these days, or is it more that you have to tell this story and to capital allocators who might be investing large institutional bucks into these treasury companies?
Yeah, I mean, look, I understand the critiques around credit rating agencies. They don't really have a great track record. Um, but at the same time, you don't hate the player, hate the game kind of thing. It's how the financial system is set up today where they do matter, because there's institutional capital that literally can't buy, junk rated stuff. And that's where like a lot of the trillions and trillions of dollars sit. And so they do unlock a lot of doors when you can get a good credit rating agency. You kind of got to play the game a little bit. But they did lay out, specific criteria. They wanted to improve they want a strategy to improve US dollar liquidity. So they created a USD reserve, reduce the convertible debt, show that they have continued strong access to capital markets, even in poor market conditions, which I mean, they've absolutely done that. Bitcoin's gone down 50%. They've raised billions and billions of dollars. They were the largest equity issuer last year. They are the largest equity issue this year, largest preferred equity issuer. I think they're showing that they still have capital market access even during a bear market. And so if strategy can accomplish those goals, or those, I guess, directives from the rating agency, they've said that they could raise the ratings. And so I do expect them to do this, but I also think it just takes time. This is a young product and it's also novel. So there's a lot of education that needs to happen, a lot of market awareness, and they have to show a track record of continuously servicing the dividends without interruption, I think. It has to season, so to speak. And so nothing really beats that above anything else. And then Bitcoin education too. People just see the volatility still, unfortunately. But Bitcoin also has to show resilience and continue to perform well.
Yep. I'm not sure how many more bear markets we're going to have to go through before people finally understand that, in legacy finance. But I've heard you talk about scale being a real moat for a treasury company, Sam. And you guys at Orange are sitting at around 4,000, almost 4,000 Bitcoin, I think, on the balance sheet last I checked in. Why is sizing so important? I guess, what risks does it protect you from?
I mean, just having a bigger balance sheet with more Bitcoin, just it, from a capital markets perspective, when you raise capital, you can typically get more favorable terms. It gives you more flexibility in terms of generating revenue if you have different yield generation strategies. It it if you do want to offer some kind of preferred instrument, you can have a higher BTC rating, right? So you can have greater asset coverage of your preferreds, which improves the credit worthiness. Obviously, I'd prefer to hold a preferred equity instrument that is backed by more Bitcoin so I can have more confidence in the company's ability to service the dividend. If I have a preferred that's backed by 1,000 Bitcoin versus 5,000 or 4,000, um, which one am I going to choose? If you have a lower BTC rating, you would likely have to offer a higher yield, because there's more risk there. Because when it comes down to it, I think it's right. Like you really, when you're looking at the risk of these things, you should really look at the coverage, the Bitcoin rating, the management team, their execution, their discipline. If there's any senior obligations in front of that, preferred, their access to capital markets, their track record, all those things come into play. But the Bitcoin holdings is a big part of it. So, kind of for all those reasons, like scale is important, and like it is a digital gold rush. That's what Saylor says, right? It's going to be harder and harder for people to obtain a large amount of Bitcoin as Bitcoin appreciates and adoption continues. So like it's not going to be as easy to get, just like it's harder to get an individual to get 10 Bitcoin than it was 5 years ago. It's going to be harder for a company to get 1,000 Bitcoin in 5 years than it is today. So that's going to be a continuously greater moat to get the Bitcoin, just sheerly because of Bitcoin's future appreciation that we expect as the adoption continues. So kind of for all those reasons.
If you're building or managing a Bitcoin treasury, you need institutional infrastructure to match. BitGo is the digital asset backbone trusted by thousands of institutions worldwide, offering regulated custody, OTC trading, financing, and settlement all under one roof. They're now a publicly traded company on the NYSE and hold a federally chartered national bank license from the OCC. For Bitcoin treasury companies, this is the infrastructure layer that matters. Learn more at bitgo.com. CoinKite has been building the gold standard in Bitcoin private key security for years, and they just raised the bar again. The brand new Coldcard MK5 brings a massive Gorilla Glass screen and new NFC functionality for a more seamless experience. The Coldcard Q is an absolute powerhouse for serious Bitcoiners, with a full QWERTY keyboard, air-gapped, and built for maximum security. Whatever your setup, executive, Bitcoiner, Bitcoin treasury, there's a cold card for you. Head to store.coinkite.com and use code 6BT at checkout for 6% off.
The tip is here, and with it, you might be thinking, is it time for me to borrow against my Bitcoin? Enter Arch Lending. They're building the most transparent borrowing experience in crypto. We're talking industry leading rates from 8.49% when you borrow against BTC, and you receive USD within minutes. Your assets stay protected with qualified custody. There's no rehypothecation, and verifiable segregated addresses are used always. As your collateral grows, you can unlock more liquidity, adjust your line anytime, and extend your term with a single click. And with 24/7 white glove support, you're never going to feel like you're on your own. Arch Lending, simple terms, public pricing, market leading rates at every size. You can learn more at archlending.com.
Yeah, yeah. You guys at Orange, you're operating in Latin America. I'd say most of the treasury companies, of course, are domiciled in the U.S. and Europe. You're the biggest one in Latin America, certainly. So, what are the specific draws to operating a company in Brazil? And I guess the second part of that, Sam, what is the state of like preferred equities in that market, and what's the path to theoretically moving to a digital credit model, maybe similar to strategy? Because there's clearly insatiable demand for that, I think, all around the globe, and I'm of the mind that I think there can be a lot of players in the digital credit sphere. Is that your read as well?
Yeah, no, absolutely. I think it's going to be a pretty large market with a lot of different players. Brazil is interesting just because there's very, very little competition here in terms of public, regulated public vehicles to gain exposure to Bitcoin. We're one of the only ones that exists. In the US, there's a ton of different options in terms of ways to get exposure to Bitcoin. There's 11 ETFs. There's, Coinbase. There's infrastructure plays. There's mining companies. There's all different. There's treasury companies. There's all different kinds of ways to get exposure. Not so much in Brazil, in Latin America. We're literally one of the only ones. So, but that comes with benefits. There's also structural reasons why a proxy, to gain Bitcoin exposure in that market is attractive. There's large pools of capital are restricted from buying spot Bitcoin. There's tax advantages in terms of holding a domestic equity to get Bitcoin exposure versus spot Bitcoin. So there's a little bit of those structural tailwinds around why it's advantageous to be in Brazil. And then there's the macro, right? If you have a view that emerging markets are going to continue to outperform developed markets, which it has over the last year, um, then there's only one way to gain exposure to like an emerging market and Bitcoin in the world, and that's our stock. So that's one of the reasons why we launched our ADR in the US, um, to give US investors kind of exposure if they want that. If lately the BRL has actually been strengthening against the dollar. And so if you own like a Brazilian equity with Bitcoin exposure, you've actually protected yourself a little bit from the downside that's happened with Bitcoin, just because of the FX currency dynamics. You want exposure to BRL and Bitcoin? Well, you could own Orange BTC. And that actually is done better because the BRL's just like really blown the dollar out of the water over the last year or two. And so there's these FX uniqueness, like these FX dynamic uniqueness to owning a Brazilian Bitcoin treasury company, which obviously nobody else can really say that. And so it's really interesting for all those different reasons. Now, the market is more immature, the infrastructure. So like crypto adoption there is extremely high. It's very innovative people. In many, many ways, the financial industry there is actually more advanced than the United States when it comes to their rails and their crypto adoption and tokenization. Like they're very progressive. But when it comes to Bitcoin like services and products, it's nowhere close in terms of like the institutional grade. And that's where that opportunity lies for a company like ours to kind of fill that void, bring our expertise, educate the local financial institutions, partner with them, and kind of bring that institutional grade Bitcoin products to the market and really just improve investor access, education, teach them why Bitcoin matters. And so all those things come with challenges though, like the US is by far the most innovative capital markets in the world, open. That's why companies like Strive and others can move really, really fast and do these things really fast because they are in the US. So there's advantages. It's highly liquid, um, very innovative, very open. It's a little bit, more challenging to navigate sometimes in a market that's not as familiar with this asset class. And so we do have plans to go down the preferred equity route, but there is some education that needs to happen with partners, with regulators. What is this instrument? Why are we doing it? How do we attach a ATM like structure to it? Like, how do we do these things? It comes with a little bit more challenges, but we do think there's a path forward to do that one day. So we're kind of working towards that, but we're taking it one step at a time. Like we're looking at creating a sustainable business in the next quarter or two. We run really lean. We're going to launch some products hopefully in the next month or two that are pretty exciting. And then probably look towards different capital market raising activity towards the end of the year, early next year, and things like that. And so that's kind of where our roadmap is. But we're just kind of laser focused. I think one of the traps that companies get in is they lose focus. They get really, they have all these great ideas, and then they kind of spread themselves thin, doing all different things at once. But really, you should just kind of really focus on an initiative, a product, a raise, get it done, move on. And that's kind of how we go about things at Orange BTC.
Cool. I know I'm myself and the team at Bitcoin Treasury is really excited to cover all the movings and shakings in Brazil and see how you guys are innovating there. So we'll be glued to that for sure. You mentioned Strive, being able to innovate so quickly in the U.S. markets. How big of a deal was it for you, Sam, to hear them, to basically get Nasdaq to I guess amend the rules so that they could be the first equity that pays dividends more frequently than monthly, and they went for the jugular. They went straight to daily dividends, like, and that's a Bitcoin company, right?
Yeah.
How cool is that? How innovative is it to see a Bitcoin company leading the way, and what's the potential there?
I think it's really cool. Yeah, no, I think it's awesome. I think it's a potentially pretty big deal. I think, I mean, they've kind of laid it out in their presentation of how it just impacts the compounding. So mathematically, it's better. I think people want to get paid more frequently. I think when it comes to like traders and implementing it into like DeFi and things like that, like daily dividends is going to be kind of a game changer. Because it kind of fits with what they want. They want kind of like almost as 24/7 as possible. All these like innovative like DeFi projects and stable coins and day traders, you know, it really changes the game a little bit. So I think you're seeing it from a price stability standpoint. Since they've announced that, it's been pretty impressive. SATA's price stability. It really stuck around par before this latest volatility of Bitcoin. It was pretty impressive, and the volumes kind of spoke volumes, but, like, the liquidity, increased as well, and so the market response has been pretty favorable, and so, that's the biggest referee of them all, and that's why they did it, right? They did it for, improving price stability, making it attractive, so I think it was great. I think seeing innovation like that from the Bitcoin treasury companies in general, kind of competition's a great thing. And so I think everyone's going to push each other to innovate, to differentiate, and just to improve this entire category of credit that's being created, a preferred equity, whatever you want to call it. There's like semantic wars right now, but yeah. So yeah. Anyway, I think it's great. I'm a big fan of that team. I think they're executing well. I know a lot of people there, and I'm rooting for everybody in this space because ultimately I think it's all good for Bitcoin.
Yeah, yeah, and I think it'll be really exciting, like you said, if they can keep that volatility in check. I mean, it's held up better price wise on this recent Bitcoin price crash, better than STRC has, and I think that really speaks volumes, for a smaller instrument that's secured by less Bitcoin than strategy has, certainly. And I think the seasoning, like you mentioned, the time in the market for these products showing that they can withstand, bear markets and being tested is going to be really interesting to see what ki- what type of creative things
No, it's just
happen.
like kudos to them too. I mean, it's really taking that on. It's really just like more work on the back end for them. So like,
Yeah.
they're like, all right, like we'll do it. Like so ultimately it's just kind of a lot of work. And so but they gotta execute. We'll see how it works. I think they're gonna do well. But they're gonna have to do it every single, trading days, pay this thing out. And like,
Yeah.
hopefully there's no operational hiccups or anything like
I was going
that.
to say, what
Um
about costs too with, managing that? It's
Yeah,
got to,
sure. It's just they think that it was a substantial improvement on the instrument, and I kind of agree.
yeah.
Definitely agree. And so it's worth the cost, worth the work. But again, it's kind of like it's what you said, like track record and seasoning. So and it's never been done before, so they're kind of in uncharted waters that way. But I think they'll pull it off. I don't. Listening to them talk about it, it sounds like it's just a matter of getting a process down and being on the same page every single day.
You probably hear some of the same chatter I do in treasury circles, and maybe it's just, FUD or on X where people talk about, there's only room for strategy and maybe another treasury company offering preferreds. And the thing is, it's pretty binary, right? If strategy succeeds, it's inevitable that other companies will succeed in offering digital credit, offering dividend paying products, and I talked with Sean Bill from BSTR, Adam Back's company, yesterday, and he was saying he kind of thought of this like kind of like the late 70s, early 80s when junk bonds really kind of came onto the scene. He's like the digital credit space is kind of like that, where there's going to be different tranches of digital credit built around Bitcoin, and Bitcoin treasury companies are going to be able to offer that. Is that a fair characterization, Sam?
Absolutely. I don't think anybody's going to catch strategy at all in terms of Bitcoin holdings. Like they'll always have that moat. They'll take most of the market for sure. I mean, they have the head start. You can't really replicate their Bitcoin holdings or their track record. It's kind of like Bitcoin. Like you can't replicate the fact that Bitcoin has the longer, better track record than anything else, barring some mistake by them. Or that's the only way that somebody could have a better track record, so to speak, than strategy. It's kind of like they could shoot themselves in the foot. That's about it. And so they'll always have that. But there's other ways you can innovate, and Strive showed that, right? Like um, Strive showed that by having like a little bit better investor protections in there. Like for instance, if they miss, I don't know if it's one or two dividends. If they miss consecutive dividends, they can vote to have like a board member. Uh, you know, uh, SEDA shareholders can vote to have somebody appointed to the board, and things like that. You can separate by or like the daily dividends. You can tweak it. You can have different investor protections baked into it. You can obviously have a different yield. You can have higher yield. So there's all different ways to kind of differentiate and innovate, and I expect to see more and more of that as they're trying to take some market share. But the total addressable market is trillions, trillions and trillions and trillions of dollars. If you even get like a sliver of that, that's a very viable business. I mean, and so I think you'll see plenty of these. It's just a matter of can the team execute in terms of designing one that could generate some demand. Um, and do they have the Bitcoin holdings to have a sufficient enough BTC rating to back it? Is their capital structure clean enough where the credit worthiness of these preferreds would be attractive? And um, yeah, so I think you'll see a ton. I think you'll see a handful maybe, but STRCs um, I think will continue to take most of the market. But even that, uh, what's left over is still a huge TAM that's worthwhile to go after if you're any of these companies. And then the actual instrument themselves. I mean, if you if you have Bitcoin and you're raising capital by Bitcoin, I mean, you want the duration of your liabilities to match the asset. So the asset is, the duration's infinity, like Bitcoin's the longest duration asset you can have. So you want liabilities, primarily that's denominated in fiat, that will be devalued over time that don't mature, right? So you can just remove, some of these, covenants and margin calls and refinancing cliffs, and you really just only have to worry about one thing, which is servicing the dividend. And it kind of simplifies everything. And so
Yeah.
it's, you know,
Yeah, it
it's
really does, Sam. Yeah, I'd like we're coming against our time here, and I do want to take like a little bit of a, I guess for this last question, maybe a broader look at where Bitcoin's headed, where the fiscal situation, globally is headed. You touched on it a little bit at the top of the podcast, but are we how does this all play out? We've got blown out deficits across the board with sovereigns, and in the United States, interest expense is coming on laughable levels. We've got unfunded liabilities in pension funds, in states across the nation. Social Security is obvious. It since I was taking like Econ 101 in college, like professors were like, yeah, early 2030s it's going to blow up and nobody's going to do anything politically because they just want to blame the other party for when, Social Security becomes, at least partially insolvent. Is that going to be a catalyst for, hyperinflation in the West? And is that the time when we see Bitcoin really kind of rip relative to fiat currency? Or I guess, can governments keep kicking the can down the road? And how does that play into the long term adoption of Bitcoin?
I think that's what's happening is like, and even Saylor tweeted something about this today, but there's just like shinier things right now. AI, the stock market's running, it's pulling capital, there's rotation. I talked about the changing investor base and how I think it's more institutional. I think you can look at the chart. I mean, it's almost like 20 to 30% of the Bitcoin in circulations held by institutions or ETFs. 5 years ago, that was like a sliver. So it's changed the way it behaves. And one of the things that institutions, when they get criticized, if a part of the market's running and they're sitting in Bitcoin and it's doing nothing, they're gonna like lose their jobs, right? They're gonna, you know, people are gonna pull their money, they're gonna lose their jobs. It's different than like an individual who has a view on Bitcoin and can just hold it, weather the volatility. Institutions have to answer to people. And so when you have AI and everything running vastly outperforming, it's not only painful for Bitcoin holders, but like really there's a rotation that happens and they start to chase that and the shiny thing. And so I think that's part of what's going on here. I think there's still complacency about the situation in the Middle East, and a lot of uncertainty there. And oil still is trading in the 90s. Oil inventories are getting drained. That matters because if you just think about, like Luke Roman talks about Maslow's hierarchy of needs, I think it's a good way to frame it because you have Japan and the UK, they need oil. They don't really make enough themselves at all. So, they're the two largest holders of US treasuries and they're going to sell them for oil. And if the oil price continues to ramp up and the oil inventories get drained, there's a lot of pressure there, inflationary pressures, as well as they're going to sell the U.S. Treasuries, and that's going to put pressure on the long end yields. You know, every time the yields go up, it adds billions and billions of dollars of interest expense, which blows out the fiscal deficits even more. So that's kind of the situation we're in. When the yields go up, it's going to put pressure on stocks, going to put pressure on any kind of perceived risk asset, including Bitcoin. Um, Now, when you look further out, yeah, I mean, the only thing that's like really tenable, I think, right now, is currency debasement. When you get to these debt levels, um, typically, you could do austerity, but at these levels, it's just not politically tenable, and it would be so painful, especially when the U.S. markets become so financialized. So you just look at tax receipts and how closely it's correlated to stock market performance. If we see any kind of major uh, stock market drawdown, we're going to see declining receipts. So even if you tried to cut spending, the fiscal deficit could still be high just because you have lower revenues because of that. So you're kind of in this tough situation where you're at structurally large fiscal deficits, where fiscal deficits are the main drivers of inflation as well as economic activity, GDP. It's no longer monetary policy and interest rate policy. That's why I don't really care so much about like cutting rates, raising rates. It's like a broken lever. What matters more is like what the Fed's doing with its balance sheet. So now it's expanding again at a slow pace. It's QE, not QE. They're buying on the short end. Um, but now we have Kevin Walsh coming in, and they've already said that they want to do a new Fed Treasury Accord. And the reason why they want to do that is they're trying to coordinate things more to kick the can down the road. Some kind of pseudo yield curve control, QE like stuff, but not QE. It'll be a different acronym. Any kind of quote unquote treasury market dysfunction is going to lead to money expansion, expansion of the Fed's balance sheet, expansion of M2. To me, that's like an inevitability at this point. It's kind of like math. And so when that happens, it's the currency that absorbs all that damage and loses purchasing power. And from that, downstream from that, that's when you see, inflation, like consumer price inflation. You see that, as almost like a side effect of the actual monetary inflation. And so it comes with inflation. With the inflation comes financial repression and capital controls because they don't want people to leave the currency. They don't want people to flee because every time somebody sells the currency, it accelerates the debasement. And so they try to trap people in. It's very, it's just, it's so, I don't know what the right word is, mean. They try to close all the exits as they kind of destroy the currency. And this
Yeah.
is just history.
Yeah.
And so this is the macro environment, and this is kind of what I was talking about earlier. It's like Bitcoin uniquely protects people against this, along with gold, like, any kind of apolitical, neutral, sound money alternatives that can't be debased, that actually preserve purchasing power, hard assets are going to do well. And then I think Bitcoin has just a really unique profile where it's liquid, it's digital, it's portable, you can move around with your head with it. It's very unique. And then it's asymmetric because it's just so small. It's still only a $1.3 trillion asset class. The world hasn't really woken up to its value. And so the asymmetric upside is unlike any other hard asset in the market. So, you brought up the Social Security stuff. And yes, like it's something that, Lynn Alden and I wrote that piece on fiscal dominance, kind of what I'm talking about here. And at the end, we say, like, the rest of this decade is going to be, it's going to be structurally hot, higher inflation, which is what we're seeing, higher deficits. It's going to continue, but it's not going to be chaotic, barring some kind of major war or like financial crisis. Like you can't really predict that. But there is this like the train tracks are headed to this like really rough path where we're gaining speed and it's really hazardous. And that's where the insolvency of not just Social Security, but Medicare happen at the same time. And the risk is that, politically, they're not going to come up with any solutions or any real like good solutions. And there's been like all these different proposals but there's really only two solutions, which is like raise taxes. So basically on the working class, aka on the youth who are completely disenfranchised, they see their paychecks. Now there's even less that they take home. Before they're already like, where does this money go? And so that's not really great. And then the other side is reduce the benefits for the elderly who are already on fixed, income. Many are reliant on their Social Security for their living. And they're already saying that doesn't keep up with the inflation because it's tied to some bogus CPI metric. And it doesn't keep up with inflation because the inflation's actually 6.7%. And so that's your solution, is like toggling that. And so you can see how it can be really, um, politically uh, hot environment where, like, generations are kind of at each other's throats about it. And the third solution is to print the difference. So what they call a general transfer, which is a fancy word of saying just add it to the debt, fill the hole, and kick it down the can, kick the can down the road another 5 years. But for trusts of that size, they've done this with smaller trusts already. Like the highway trust, they did this, and they've done this with other things. They just threw it on the debt. It went insolvent, and now it's going to go insolvent in 4 years, and they'll just do it again. But we're talking about adding $1 trillion plus to fill that hole in 2031 on top of the deficit. So we're talking, if we're running $2 trillion deficit or whatever, now it's going to be three. And you could see how that could really shake the confidence in the long-term fiscal sustainability and cause yields to spike. Interest expense then spikes. Now it's a $4 trillion fiscal deficit. And that's when the currency can really start to devalue. And so I do see it as like this thing on the horizon where you could really see the debt explode, the deficits explode, and then the currency really fall. I wouldn't say, I don't know, hyperinflation is such a, the dollar is going to be, there's a lot of demand for the dollar. All right. So I don't really think like there's going to be hyperinflation at this moment, but a significant devaluation, if they decide to do that stupid thing, which is try to fill with just more money printing and more borrowing.
Yep.
That it would
They're
just be
going
a
to.
really poor policy decision.
I
Let's
think
just
they're
say.
going to, like I think it's like they're going to view it as the best of a bunch of horrible options.
It'll be the easiest short-term option, which is why they might do it. But it is
Yeah.
like it's this really harmful, and like, so like I really like the Committee for Fiscal Responsibility budget. Wait, let me see if I get this name right. I always mess it up. Yeah, the Committee for a Responsible Federal Budget. It's this really good committee that puts out good research, and they're just like, please don't do this. Like they're like, this would be a horrible, and they like model it all out about how much, the debt could explode if they decide to do this, and they're just trying to like warn everybody, like, don't try to fill the hole with Social Security and Medicare when it comes to it. But I gotta say, I'm not that optimistic that they won't at least do that, some of it. So anyway, yeah, that's what we're looking down, and it's only 5 years away. That's
Right.
the thing. It's like it's not far away. This has been a long-term problem for a very long time,
Yep.
and it's always been like, the next administration will deal with it. Well, it's here now. So, um, and we talk about the fiscal budget and the fiscal problem. It is the entitlements. Like, they expect 90% of the spending over the next 10 years to come from Medicare, Social Security, and interest expense. That's it. All right. So if you don't fix the entitlements, you're not doing anything. And Doge showed that. Like,
Right.
doesn't even matter
Right.
with defense. Like, entitlements are the entire problem. And so if you don't touch them, you're not fixing anything. So that's why, like, it should be the main topic in Congress right now on a daily basis. But instead we're doing all, whatever they do in Congress. It's
Yeah, it's good. There's going to be a face-off. We're running up against time here. I've got another recording, Sam, but I'll plug all your stuff on a
sure.
recording. I'll splice it in there. One thing I have all my guests say before they leave is "Stay orange."
Oh, cool. Stay orange. Stay orange
especially
BTC.
especially relevant for you, ladies and gentlemen. Sam Callahan.
Thanks for having me.